Welcome back. You're watching Your World at 10 now. On 21st February, after a 5-year period, the U.S. Federal Reserve released the records of 14 meetings from the year 2008. The hundreds of pages of transcripts from those meetings show that the Federal Reserve struggled in many ways to grasp the scope of the financial crisis. The transcripts also shed light on the record of Janet Yellen, then chair of the San Francisco Fed and now, of course, the chair of the Federal Reserve. Yellen's reputation for calling the recession ahead of her peers is borne out in those Fed documents. In a January 21st meeting, she said, and I quote, "The risk of a severe recession and credit crisis is unacceptably high, and it is being clearly priced now into not only domestic but also global markets." Though at that time, not too many members of the FOMC agreed with her. For the key takeaways from those Federal Reserve records and what it tells us about the world's most powerful central bank, I'm joined now by two reporters who have studied them closely. Binyamin Appelbaum, a Washington correspondent at the New York Times, and Ylan Mui, financial reporter at the Washington Post. Binyamin, Ylan, thank you very much for joining me. Binyamin, can I start by asking you what you made primarily of those transcripts that you have read through and what they tell us about how prepared the Fed was, not for an event of this nature, which was a totally unprecedented event, but being able to grasp the data that was coming through at that point in time and take aggressive action?
I think the most striking thing about these transcripts is the extent of the Fed's ignorance about actual economic conditions in 2008. As you say, obviously something unprecedented was happening, and it's probably unrealistic to think that any group of economists was going to be able to anticipate the depth of the crisis that occurred. But Fed officials actually thought the economy was growing. They seemed blind even to the possibility of a normal recession, even to the depth of the emerging problems, even to signs of rising unemployment, rising stress in financial markets, the potential that that would spill over into the real economy. It's a portrait of a group of people who are being expected to do something, manage the economy, that they seem to have been utterly unequipped to do.
Okay, I'm going to ask you whether part of that being unequipped also had to do with the kind of data that they were looking at. But before I do that, Ylan, your key takeaways from those transcripts that you read and what they tell you about the Fed Reserve.
Well, I think that what you're seeing is actually sort of the evolution of Ben Bernanke through 2008. You know, he started the year definitely concerned about the unemployment rate, concerned about the number of jobs that were being created or not being created in the economy. But it took him until really September, until the fall of 2008, when you actually saw Lehman start to crumble and you actually saw AIG sort of teetering on the brink, for him to realize there's no more doubt that we're actually in a recession now. So that was at the point when the economy was already a year into the recession. So it took him sort of a long time to realize where the economy was. Once he did, he then sort of had to act much more quickly, much more aggressively in order to counter the growing crisis.
Ylan, would it be fair to say that the Federal Reserve was unable to grasp the severity of the problems presented by the Lehman collapse? And so that for the longest time right after the collapse, they in fact thought that they had done the right thing by allowing Lehman to fail.
There was hope, I think, among the Fed that this was as bad as it was going to get, right? That this was going to be the extent of the problems, and there was sort of this optimism that things were going to turn around quickly. And even one Fed official, Jeff Lacker from the Richmond Fed, said he hoped that this would be a moderate recession. Unfortunately, as we know, that was not going to be the case. And as the final months of 2008 sort of bore out, Ben Bernanke had to take a much more aggressive stance with some of the officials who were his colleagues, by saying this is not going to be a normal crisis. You know, this is something truly extraordinary that we're going to have to respond to.
But that took a few months, that realization took a few months to come. Binyamin, did you sense in those transcripts as you went through them that maybe at a later date, after the Lehman collapse, they had some cognizance of what they had allowed to happen by allowing Lehman to fail?
So it's clear that the Fed actually, I think, fairly quickly grasped the magnitude of Lehman's failure and the consequences that it has unleashed. I think that many Fed officials would say up until the present moment that they had no choice but to let Lehman fail. So they didn't necessarily see it as an avoidable failure, but there was this initial burst of optimism that maybe things were going to be okay, maybe the worst was past, maybe this had been a good thing, and then very quickly a realization sets in that the ripple effects of that failure are bringing down global markets or toppling other firms or putting unacceptable stresses on the global economy. And really within the space of weeks, they're rushing to respond to it and to stem the damage.
You spoke about their unequippedness to deal with a crisis of this magnitude. I want to go to the data that the Fed was viewing at that point in time, because that continues to be the data that all of us judge this U.S. economic recovery by. And it does seem in your article that you've said the Fed's understanding of the crisis, however, was clouded by its reliance on indicators that tend to miss sharp changes in conditions. What did you make of the data in front of them? And did you notice in those transcripts whether they themselves acknowledged the data was insufficient?
They do have some awareness of the shortcomings of the data. They do know that they're flying a little bit blind during 2008. They do reference the fact that they tend to speak in terms of probabilities, and they do describe the chances that they're simply wrong about what they're seeing, although they don't seem to have accounted for that in terms of their policies. But broadly speaking, there were three problems. There were three reasons that the Fed was blind, and only the first of them is this bad data problem, which is still a reality. Exactly as you say, they're still using the same data. They remain equally vulnerable to quick changes in economic conditions, because so much of that short-term economic data basically assumes that trends will continue, and they really have no ability to see abrupt changes in business conditions. But there were two other problems. The first of those problems is that their economic models basically assumed that financial markets function smoothly. There was really no ability in those models to predict or analyze the consequences of financial market breakdowns. The dominant school of economic modeling has sort of assumed that markets are transparent, and this was a crisis that happened because markets were not well functioning, and the Fed was blind to it because of the way that it models the economy. And then the third issue is that it's an institution that has biases, and one of the strongest biases is this overriding concern about inflation. And so when officials were looking at this data and seeing rising unemployment, for example, they were very quick to discount it and to write it off and to explain why it didn't actually mean that the economy was collapsing, because they had this overriding concern about inflation.
It's interesting you bring up inflation, because I'm going to refer to both the articles that each one of you has written to talk about how inflation was a worry even back then in 2008. Ylan, you've quoted in your article a quote from the head of the Federal Reserve Bank of Kansas City. This is Thomas Honig, saying that I also encourage us to look beyond the immediate crisis, which I recognize is serious, but as pointed out here, we also have an inflation issue. Look, we have the benefit of hindsight, so it does seem almost comical now that the Fed would be, or the FOMC members would be, worried about inflation way back in 2008.
Well, that's right. I think that, at that point in time, the Fed has a dual mandate in the U.S. to maximize to maximize employment and also ensure price stability. And at that point in time, a lot of people were sort of coming out and still remembering the Volcker era, when there was massively high inflation, and that was a big challenge facing the Fed. What we know now as a challenge facing the Fed is the issue of high employment, not high unemployment, not high inflation. But that was something that the Fed was slow to realize. And actually, there are many members of the Federal Reserve today, probably Tom Honig would say the same thing now, is that the Fed is still not keeping its eye enough on inflation and worried too much about unemployment, and possibly maybe sowing the seeds for inflation in the future. So, there is some tension within the Federal Reserve over how much weight to put on both sides of its dual mandate.
Yeah, I'm glad you brought that up, because even a broken clock is right twice over. And there are several members on the FOMC, whether it's the Richmond Fed president or even Richard Fisher, who didn't seem ready to take aggressive action. And interestingly, in both of your articles, you point that the two people who were ahead of the curve to some extent and were ready to take aggressive action were Ben Bernanke, the former Fed chief, and the current Fed chief, Janet Yellen. Binyamin, what does that tell us about the leadership of the Fed and both these people's ability to come to grips with the problem fairly quickly, or at least faster than the rest of their colleagues?
It's striking, because Ben Bernanke, as you say, was one of the more prescient members of the committee, saw fairly clearly that there could be a major crisis unfolding, warned about it. But what is striking is how unsuccessful he was in convincing some of the other members of his committee that he was right, and how little he pushed for some of the stronger actions that his concerns might have dictated. So in January 2008, you have Bernanke saying, we're at risk of a very serious recession, of a historic event, a historic downturn. We really ought to be taking out insurance against that possibility by lowering the Fed funds rate, benchmark interest rates, another full percentage point. And then he proceeds to recommend that the committee doesn't do anything like that. In September 2008, at the height of the crisis, you have Bernanke saying, we are in recession. and then announcing that he doesn't want to lower interest rates. So there's this odd disjoint between his clarity as an economic forecaster and his willingness to push for the consequences of those views. I think it's really interesting to compare Janet Yellen with that sort of hesitation that Bernanke displayed, because she was both as prescient as him, perhaps even more so, in assessing the extent of the economic danger, but also much more forceful in pushing for action, much more forceful in insisting that the Fed ought to do more. Neither of them saw the full magnitude of the problem. Really, no one did at the time. But there's a real striking contrast in styles, and it suggests that in similar circumstances or in confronting other challenges going forward, Yellen is likely to be much more assertive about her own views and her own sense of what the Fed ought to do. We don't know how that will play out inside the Fed. It is a committee. It may be that members will respond less well to that than they responded to Bernanke's more passive style. But you really see the contrast in the style of these two people during those crisis months of 2008.
Well, that's a great insight. Ylan, my final question to you is this, and it's a quick one. Markets would do well then to put their faith in Janet Yellen, because there's been a lot of skittishness around the taper, and now that we're at 6.6% in terms of unemployment, there is a lot of worry about when the interest rate cycle will turn. I suppose these minutes show that Yellen has her finger on the pulse.
Well, I don't know if how much faith the market should ever put in some Fed forecast, but what I would say is that it is clear from these transcripts that she even said that she'd be willing to do whatever it takes to make sure that the economy recovers from the financial crisis, and I think it's clear that she would do whatever it takes now to ensure that the recovery doesn't stumble. The question now becomes sort of the flip one, which is, is there a danger then of the Fed getting behind the curve as it tries to ensure that we have strong economic growth? Is there a limit to Fed powers, and is Janet Yellen going to be able to see that?
You mean, will inflation, in fact, now become a problem? Ylan and Binyamin, thank you so much for those insights. That's a glimpse into the world of the Federal Reserve in that crisis year of